Fiscal policy is government's use of spending and taxation to meet macroeconomic goals. So, a government's budget is said to be balanced when tax revenues equal government expenditures. We started this in the beginning. Budget surplus occurs when the tax revenues exceed expenditures, and a budget deficit occurs when the expenditures exceed the tax revenues. So Keynesian economists believe that fiscal policy, through its effect on aggregate demand, can have a strong effect on economic growth when the economy is operating at less than full employment. That is, by cutting taxes, by increasing government spending, aggregate demand can be increased such that employment or the economy can come back to its full potential or full employment level, as we discussed. Generally, this is changing taxes and government spending in social programs, in constructing infrastructure, so on and so forth. Monetarists believe that the effect of fiscal stimulus is only temporary, and monetary policy should be used to increase or decrease deflationary pressures over time. So, monetarists do not believe that monetary policy should be used to influence aggregate demand to counter cyclical movements in an economy. So, monetarists believe that inflation level in an economy can be well managed with the help of monetary policy. So if you want to increase or decrease inflation, you can do that very well with increasing or decreasing money supply. However, aggregate demand cannot be changed by monetary policy. So to change aggregate demand, you may still have to resort to fiscal stimulus. You may still have to resort to tax cuts or increase government spending. However, monetarists believe that this impact on aggregate demand will only be temporary. Keynesian believes that it is the good thing or it is the right thing to do to influence economic activity, or fiscal policy is the right thing to do to influence economic activity. Fiscal policy, we'll study in more detail, is what you do with taxes and government spending. Discretionary fiscal policy is the spending and taxation decisions that are intended to stabilize the economy or that are taken at your discretion, depending on the state the economy is, depending on the inflation level, depending on the aggregate demand, depending on the employment and economic growth. Automatic stabilizers are built-in fiscal devices that are automatically triggered at all states of the economy. So tax rates are a very good examples of automatic stabilizers. So the way the tax is calculated is as a percentage of the PBT. Automatically, when the PBT is low, tax in absolute amounts will be low. And when the PBT is high, so when your income is high, automatically you're paying more tax. And when your income is low, you're paying less tax because tax is calculated as a percentage. So this is an automatic stabilizer. In good times, you penalize more. In bad times, you penalize less. So you don't collect a fixed tax from the people, or you don't collect a fixed tax from corporates. Automatically, when profits are low, you collect less tax, and when profits are high, you collect more tax. So it's an automatic stabilizer. It can be argued that the government needs fixed tax revenues, right? Why should tax be a percentage of profits? Government needs tax to do its activities, to do its social objectives or whatever it does. It needs a fixed money. Why does it need more money when incomes are higher? Or why does it need less money? But these are some of the automatic stabilizers built in to today's financial systems. Similarly, unemployment claims. Are automatic stabilizers. Automatically, when economy is in a bad shape, the unemployment claims will be more. The government is spending more. And when economy is doing well, unemployment claims will be less. The government is spending less. And which is what the prescription also is. That during bad times, government should support. Government should spend more, should cut taxes. During good times, government should cool down. So it should spend less and it can collect more taxes. Objectives of fiscal policy. First is to influence the level of economic activity and aggregate demand. So that is increase growth. Second, redistribute wealth and income amongst segments of the population. So generally, all governments today are social in their approach. So it is believed that the richer people should pay more taxes and the poorer people should pay less taxes, and the government should redistribute wealth to some extent from the rich to the poor, especially enough so that everybody has a minimum standard of living, or especially to guarantee a minimum standard of living to all citizens. Allocate resources amongst economic agents and sectors in the economy. So a lot of times we need investments in the economy that wouldn't be done on their own. So a lot of investments will give us returns after 50 years, after 100 years. Will any entrepreneur make these kind of investments? They won't, because the entrepreneur is going to die by that time. So any entrepreneur will make investments based on what he is going to be able to see in his lifetime, 10, 20, even a 30-year view he can take. But nobody takes a 100-year view. Governments are expected to take that view. So if climate control is important, because it will destroy our planet in the next 100 years, or actually, if you go by the studies, much sooner than that, then government has to make all these investments in R&D, in controlling, or in these investments where returns are not very immediate, which entrepreneurs or the sector or the economy left to its own may not make. So policy, first, influence economic activity, that is, get the economy to full potential GDP, promote employment. Second, redistribute wealth, tax the rich a little more, provide a minimum standard of living, and allocate resources amongst economic agents and sectors. What are the tools of fiscal policy? So there are spending tools, that is, there is transfer payments. So these are entitlement programs or subsidies that redistribute wealth. So we tax the rich and we give some subsidies to the poor, or we give some subsidies to some activities. So unemployment, insurance, social security, etc. are transfer payments that the government can make. These are not included, as we studied, in the GDP computations. Current spending refers to the government purchases of goods and services on an ongoing and routine basis. So this is the social programs that the government runs. The government has to pay the police, the judiciary, the lawmakers, the basic infrastructure, electricity, etc. that the government provides. So this is a part of the government's current spending. Capital spending refers to the government spending on infrastructure such as roads, schools, bridges, hospitals. So this kind of spending is expected to boost future productivity of the economy, or future is expected to deliver future income, and it is an investment today. It's like the capex that corporates will do. So what is the justification for spending tools? So government needs to spend money on national defense, which will benefit all residents of a country, and government needs to provide infrastructure so that there can be economic growth, so that entrepreneurs can build businesses around the infrastructure that the government has provided. Providing a good judiciary is a good infrastructure that the government provides to the citizens and to businesses, so that we know that our rights are protected. The money we earn can't be taken away from us. It's ensured because there is a good judiciary, there is a good law enforcement. So the government has to provide all this infrastructure and do all this current spending as well as capital spending so as to ensure economic growth. Support the country's growth and unemployment targets by affecting aggregate demand. Provide a minimum standard of living. Subsidize investment in research and development for certain high-risk ventures which are consistent with future economic growths or other goals, for instance, green technology. So we discussed these are the reasons why the government needs to spend. Goods that benefit everyone, for example, national defense. Provide infrastructure. Provide growth and unemployment or reduce unemployment. Provide a minimum standard of living. Subsidize long-term research or subsidize other goals. What are the tools that the government has to affect this policy? Direct taxes are levied on the income or the wealth of corporates and individuals. So income taxes, wealth taxes, estate taxes, corporate taxes, capital gains taxes are all examples of direct taxes. So these taxes are generally progressive in nature. That is, richer have a higher tax rate and poorer people have a lower tax rate. Anyways, tax rate is a percentage. So less wealthy people will pay less tax even if the tax rate was the same. But the tax slabs are also seen to be progressive. That is, not only as a percentage they will pay lower, but even the tax rate for them will be lower. That's the socialistic agenda of a lot of governments, that the tax rates are progressive. Indirect taxes are levied on goods and services. So these include sales tax, value added tax, excise tax. So indirect taxes can be used to, again, enhance the budget of the government that can be used for all these programs. And indirect taxes can be used to reduce the consumption of certain goods and services. For example, alcohol, tobacco, gambling are taxed very heavily across the world today because governments want to reduce the consumption of these activities. So indirect taxes are on goods and services, remember. Direct taxes are on wealth or income. Important to remember and realize. Advantages of fiscal policy. Social policies such as discouraging tobacco can be implemented very quickly via indirect taxes. Quick implementation of indirect taxes also means that government's revenues can be increased without any significant additional costs. Disadvantages. Direct taxes and transfer payments will take time to implement, delaying the impact of the fiscal policy. So the tax that you pay is once a year at the end of the year. So if I increase taxes today, it will be 12 months at least before the additional tax comes to me, unless I'm increasing it just one day before you file your returns, which will not be the right thing to do because people did their planning based on the taxes that they were supposed to pay. So generally you won't increase or decrease the taxes at the end of the year. You will increase them at the beginning of the year so that people can plan their whole year depending on what tax they have to pay. So again, these policy tools will take at least 12 months to fructify. So they are not as quick as indirect policy tools. Similarly, capital spending will take a long time to implement and the effect may take even longer. So if I'm building a bridge, then or I'm building a new flyover or a new tunnel, then it will take a longer time. And by the time the economy and the residents feel their impact and the additional benefit may take even longer. So what you set out doing or why you took a fiscal policy decision to begin with may not even be relevant by the time the decision actually takes effect. So these are some problems of fiscal policy tools. Again, just like the money multiplier we saw in the fractional reserve system, there is a fiscal multiplier as well. That is, changes in government spending have magnified effects on aggregate demand. So this is because people whose income increase from increased government spending will in turn increase their spending, which increases the income and spending of others, and the magnitude of the multiplier effect depends on the income tax rate and the marginal propensity to consume. So let's say, let's understand the marginal propensity to consume and the marginal propensity to save, which is equal 1. So marginal propensity to consume tells you that if you get $1 additional income, how much of it will be spent. Marginal propensity to save tells us that if we get $1 of additional income, how much of it will be saved. Understanding? For rich people, generally, the marginal propensity to save is higher because they are already consuming whatever they can. For most people, if the income goes up by $10, you're not going to start eating more food. You're not going to start wearing more clothes. Of course, you can buy more expensive clothes, but the richer you are, the marginal propensity to consume generally is not as high. Marginal propensity to save is higher. More will go into investments. You'll invest more, you'll save more if your income goes up. For some people, for developing market, developing economy especially, where people are not as rich, marginal propensity to consume is higher. So if they get $1 additional, a big part of it, they will upgrade their consumption. They will buy better food, they will consume better clothes, but they will consume most of it and save less of it, of the additional money. But of course, nobody will spend all the money. Generally speaking, we've seen there is some marginal propensity to save and some marginal propensity to consume. So let's assume the marginal propensity to consume is 80%. That is in an economy. That is, if I get additional income of $1, 80% of it will be consumed. In such a case, $100 additional spending by the government would mean somebody's income increases by $100. If the government spends, the government will spend in building a hospital, or it will give you a subsidy for your fuel or a subsidy for your electricity. So somebody's income will go up by $100. Please understand, if the government spends $100 in the economy, money which it has probably collected from tax or from whatever sources, it may be borrowing from other governments and spending. How it is spending, we're not interested. What we're saying at the moment is that if the government spends $100, somebody's income will go up by $100. Can everybody imagine that? That $100, the person will spend 80% of it because the marginal propensity to consume is 80%. And if the tax rate is 25%, then of the $100, anyways, 25% he has to pay tax to the government. So he gets 75% of it. And of the 75%, 80% he consumes. So $60 additional consumption he gets in the economy. That $60 will increase somebody else's income by $60. Because this is the amount that he has consumed, not saved. $60 that is an income to the next person, 25% of it will go in taxes. We're assuming the tax rate is 25%. And that person also has an 80% propensity to consume. So you understand that spending in the economy will go up by much more than the $100 that the government has spent. So this phenomena will keep going on, and you can say that just like we calculated the money multiplier, it can, in exactly the similar fashion, this R is the common ratio from the geometric progression that this will now be. So the fiscal multiplier will be 1 upon 1 minus the marginal propensity to consume into 1 minus the tax rate. So if I have $1 more into the economy, then it means 1 into 1 minus tax rate more income. $1 is somebody's income, into 1 minus tax rate into MPC is what will be consumed. Next guy will get this much extra income. That is, the consumption is somebody else's income. And he will again consume, pay his taxes, and then consume on it. So again, the first term upon 1 minus the common ratio. The common ratio now is the marginal propensity to consume into 1 minus the tax rate. So $1 of additional government spending will increase aggregate demand by 1 upon 1 minus MPC into 1 minus T. Another important formula that may be tested, so you should remember it. Money multiplier, remember, was what? 1 upon R, where R is the reserve requirement. This is how much the money supply in an economy will grow up if the central bank puts in $100 in a bank's account, or if the central bank puts in $1 in the bank's account, banks will actually lend this much money. Fiscal multiplier is 1 upon 1 minus the MPC into 1 minus C. What is the fiscal multiplier? It is the increase in aggregate demand resulting from a $1 increase in government spending. $100 increase in government spending will result in 100 upon 1 minus MPC into 1 minus T increase in aggregate demand. Everybody understands this? MPC is the marginal propensity to consume. Marginal propensity to consume plus the marginal propensity to save is equal to 1. Brings us to the concept of a balanced budget multiplier. So in order to balance the budget, the government can increase taxes by $100. So if the government spent $100 as in our previous example, it has to get this money from somewhere. To spend additional $100, the government needs this additional money. The government can borrow from other governments, or the government can increase taxes by $100 to just offset a $100 increase in spending. So if the government increases taxes by $100, what will be the decrease in consumption? 80% was the marginal propensity to consume. So a $100 decrease or a $100 increase in taxes will reduce consumption by $80 because the marginal propensity to consume is 80%. So anyways, $20 people were saving. So $100, $80 is the consumption that will go down. If $80 goes down, then it will reduce somebody else's income also. So just like an increase in spending increased aggregate demand by the fiscal multiplier, a decrease in spending or a reduction or an increase in taxes will also have that multiplier effect. $80 goes away from somebody's income. He will consume $100, you raise taxes. That means $80 consumption is hit, or $80 income is hit. That means for the next person, the consumption is hit by 80 into 25 because he'll pay lower taxes also. If income is lower by $80, then he'll pay taxes also lower to the extent of 25% of this number. So 80 into 1 minus 0.25 or 80 into 0.75 is what somebody else's income will go down. If somebody else's income goes down by this much, how much will his consumption go down by? 80% of this. So what we've seen is that if we take $100 out of the economy, then 100 into the marginal propensity to consume into the fiscal multiplier. What is the fiscal multiplier in our example? You can understand that just like increase in spending increased everybody's income, a reduction in spending will also have a waterfall effect. It will decrease one person's income, it will decrease the other person's income. So everybody will decrease their spending also in a multiplier fashion, just like the increase in spending increased incomes in a multiplier fashion. So the fiscal multiplier was 1 upon 1 minus the marginal propensity to consume into 1 minus 0.25. Please verify this comes out to be 2.5. 1 by 4, that is 1 minus 0.8 into 3 by 4. How much does this come out to be? 0.8 into 0.75, 1 minus 0.6, that is 1 upon 0.4, that will be equal to 2.5. So if we take $100 out of the economy, or if we increase $100 out of the economy, the only difference is that entire 100 into fiscal multiplier won't come out. 100 into the marginal propensity to consume into the fiscal multiplier will come out. and marginal propensity to consume normally is less than 100%. So if we increase $100 into the economy, then 100 into 2.5 aggregate demand gets simulated by 100 into the fiscal multiplier. That is $250. But if we raise taxes by $100, the demand destruction is not to the extent of $250. The demand destruction is to the extent of the marginal propensity to consume into the fiscal multiplier. So it is only to the extent of $200. Or the balanced budget multiplier says that if the government spends $100 and increases taxes also by $100 to balance the budget, aggregate demand will still go up by $50. If, however, the government increased taxes by $125, demand would not go up. Because exactly $250 you have stimulated and $250 you have retracted. So basically the argument favors government spending by additional taxation. So the balanced budget multiplier says that if $100 is spent by the government, it increases the total demand by 100 into the fiscal multiplier. But what is reduced by $100 in additional taxes is not 100 into fiscal multiplier. It is 100 into fiscal multiplier multiplied by the marginal propensity to consume. So to that extent you get benefited. So you get benefited to the extent of the fiscal multiplier multiplied by the marginal propensity to consume if you spend more by taxing. Now, increases in current deficit would mean greater taxes in the future. So if the government spends more by increasing a deficit is when the government's revenues are lower than the government's spending. Because the argument is that if spending is so good, government should keep spending, right? Because spending creates additional demand in the economy. Government spending created $50 more demand in our example. However, borrowing to do spending is not as good. But in this case, our budget was balanced. That is, we did additional spending with additional taxes. We didn't increase our deficit. If the government spends more money by creating a deficit, that is by not increasing taxes. That is, you spent money but you did not raise taxes. What that would do is increase the budget deficit. So what an economist called Ricardo Barro was his name, what he said is that if you do that, then people's marginal propensity to consume reduces. That is, people start saving more. So if they see that the government is spending more, then people realize that in the future the government is going to tax them more, because the government has no other source of income than the people and the income that the people are generating. So people generally reduce their consumption in response to very high government spending. If government is spending very high, people start reducing consumption because they know that they will be taxed higher in the future, or they will have to save for this spending that the government is doing, and hence it may not have the intended impact. Sorry, the name of the economist is David Ricardo. So if taxpayers reduce current consumption and increase current saving, then there is no effect on aggregate demand. Aggregate demand goes up because we are assuming the marginal propensity to consume remains the same, and people will keep on consuming, and hence the multiplier effect will kick into place. If the people reduce their consumption, then the spending will not have that intended impact. The balanced budget multiplier of additional $50 will not come if people decrease their consumption. Now guys, why should you be concerned with the deficit that the government is running? Or expansionary fiscal policy means that the government is running a deficit, or the government is increasing deficits. If the government is increasing its deficit, that means it's in a expansionary policy, and vice versa. Problem with high deficit is that it will lead to high future taxes. High future taxes will disincentivize working and will disincentivize entrepreneurship, and hence lower economic growth. If markets lose confidence in the government, high fiscal deficit means high debt also. How will you fund a deficit? By debt. That is the only way. If you are spending more and you are earning less, that means you need to borrow. That is fine. If actually your spending isn't productive, a lot of countries today run deficits, by the way. Okay, Hong Kong doesn't, Singapore doesn't. Hong Kong has a surplus despite the low tax rate. But many economies, the US runs a very big deficit. A lot of emerging countries run a very big deficit. It is not necessarily a bad thing. If the spending is happening in productive ends, that it is used to create infrastructure, it is used to create long-term economic growth, then the deficit may be justified. People will be willing to fund it. People will be willing to invest in your country. A lot of developed countries today are funding the deficits in the developing countries because they know that the returns will come over time. However, if the markets lose confidence in your government and the spending that your government is doing, if the market feels that the government spending is happening in wasteful expenditures, it is happening in giving short-term freebies to the people, then governments or people may not be willing to fund that deficit or may not be willing to fund that debt. So this can lead to the government defaulting, especially if the debt is in a foreign currency, or the government having to simply print more money if the debt is in local currency, and printing money would eventually lead to higher inflation. So of course government or the central bank will have to print money because you owe someone $100. You ran a deficit. That means you spent more than what you earned. You spent more by borrowing. That means in the future you have to return that borrowing. Now to return that borrowing, you should earn more, and that is how you should logically return. So whatever extra spending you have done today should theoretically result in higher income in the future, and that higher income should be used to repay the debt that you have earned. But if the government is not able to earn because the government spending was not in productive purposes, it was wasteful, then the government will not be able to earn that higher income in the future. So to return the money or to return that high debt, the government will simply have to print the money and give it to the guy. He will have to print additional money and say that, okay, this is the borrowing that I did from you, so this is how I'm returning it. Central bank can do that because they can print money. But this kind of printing will lead to excess money in the system and will cause excess inflation, and it will cause all the problems related to excess unanticipated inflation. So people will lose confidence in the money. That currency will depreciate. People will not want to hold that currency. Currency will lose its use as a store of value. People will want to buy more real assets. So it will have all these consequences of higher inflation. If increased government borrowing leads to increased interest rates, then corporates and entrepreneurs may not be able to borrow, and hence it will result in a phenomena called crowding out. That is, if government is running very high deficit, if government is doing too much activity, if the government is spending too much money, then the government needs to borrow from the people, from the banks. If the government is borrowing and government borrowing is risk-free, and government borrowing already is giving a high rate because the government is doing so much borrowing, then for corporates the rates will be even higher. At such a high rate, our industry may not be competitive, and it may lead to private investment going down. This phenomena is referred to as crowding out. So if crowding out happens, that means your economy is run more by the government, which is generally not a good thing, because private investments have been seen to be a lot more efficient and a lot more productive than government investments and government spending. So the problem with high fiscal deficit: first, high future taxes. You may have too much debt. People may lose confidence in your debt. It may result to printing of money. It may result to government defaulting. It may result in crowding out also, the third problem. Crowding out means private entrepreneurs may not be able to invest because interest rates have become so high because government is borrowing so much. Why should you not be concerned with the fiscal deficit? First of all, they said that if the debt is held by domestic citizens, then the scale is not as big as if it was in a foreign currency, because domestic debt you can still print. It will cause inflation, but it will only cause inflation. It may not be such a big problem. If debt is used to finance productive investment, future gains will be sufficient to repay the debt, as we discussed. Fiscal deficits may prompt the much needed tax reforms. So if currently our tax reforms are people are paying too low a tax, or some activities are not being taxed at all for historical reasons, now with the excuse of a fiscal deficit, government can start taxing these activities. So a tax reform may be implemented. Deficits would not matter if people start saving more. The theory of David Ricardo that we just studied, that if people start saving more in anticipation of higher future tax, then government deficit will be made up for by the higher private savings, and interest rates for corporates will not go up, or crowding out will not happen. So the problem of crowding out will not happen if a Ricardian equivalence holds. In such a case, there will be no crowding out because supply of money also increases. Demand of money increases because government is borrowing more. But as government is borrowing more, people are starting to save more also. If they are saving more also, that means saving means you have more money to lend. That is, you're lending, you're saving with the bank, and the bank can lend at a lower rate. So if people save more also, there will be no crowding out. Finally, if the economy is operating at less than full capacity, that is, there is full potential GDP, then deficits do not divert away from productive uses. On the contrary, deficits can help in increasing the GDP and increasing the employment. So, of course, if you're at full capacity, then you may overheat. But if you're at less than full capacity, this is the Keynesian theory. This is the Keynesian economist's argument that spending will bring back the economy to full potential GDP. Now, again, implementation, discretionary fiscal policy is what the government generally can implement by changing tax rates and by changing government spending. Automatically takes place. That is, unemployment claims and tax rate we discussed will automatically kick in. So again, it's not very easy to determine what the fiscal policy decision should be. Whatever decision that the government takes, increasing government spending, increasing taxes, decreasing government spending, or decreasing taxes, can have a problem because of three reasons. First, there can be a recognition lag. That is the time taken to recognize the problem. The time taken to recognize the nature and extent of the economic problem, be it unemployment, be it inflation, be it lack of growth, be it something else. So between the time you take a discretionary fiscal policy decision and the effect happens, there can be many lags. First is recognition lag, that is the time spent in recognizing the problem. There can be an action lag, that is the time the governments take to discuss, vote, and enact fiscal policy changes. If tax rate has to be changed or if anything has to be changed, it will take time, even after you've realized the problem, between what the actual decision or the implementation you do. There will be an impact lag, that is a time between the decision that has been taken and the actual effect seen on the economy. So if you increase taxes, how that reduces consumption, or if you decrease taxes, how that increases consumption, will not be instant. So between the recognition lag, action lag, and the impact lag, the problem may have already changed. So what you set out fixing may no longer be the problem. So these are some of the problems that you have to be careful about. Additional issues come from misreading economic statistics. So a lot of the data on inflation, industrial production is not exactly measurable. So employment also may not exactly be measurable. If somebody is working from home, if somebody is getting paid in kind, all that things we may not be able to capture. So economic statistics may be misread or may not be exact. There can be a crowding out that we've just discussed, that is expanding fiscal policy may crowd out private investment, reducing the impact on aggregate demand. If economic activity is slow due to supply shortage or due to resource constraint and not due to low demand, then again fiscal policy will fail to achieve its objective and will only lead to inflation. So if supply side is the problem, that is the economy is already working at full potential, that is people are employed and we are using all the raw material we have no more further raw material, then there is no way that the economy can produce more. So in supply shortages, any fiscal policy or monetary policy will only result in inflation. Higher demand will only result in inflation. Just like in monetary policy we studied interest rate can't go below zero, in the case of fiscal policy there is limit to the amount of deficit we can run. We can't run very high fiscal deficits. So even fiscal deficit or the amount of excess spending we can do is limited. Again, fiscal policy has multiple targets. You want to have low unemployment also. You want to have low inflation also. Generally, it is tough to control all these things simultaneously. If you reduce inflation, growth will also come down. If you increase growth, some inflation will also come with the growth. So achieving these multiple targets can be difficult. Now, in the case of monetary policy, we said that if the rate is below the neutral rate, monetary policy is expansive. And if the rate is above the neutral rate, and what is the neutral rate? It is the real long-term trend economic growth plus the expected inflation. Please remember that. In case of fiscal policy, it is not just a surplus or deficit. So it is more the change in the surplus and the change in the deficit that decides whether fiscal policy is expansionary or contractionary. So if your deficit is becoming bigger, then we will say that the fiscal policy is expansionary. So if deficit becoming bigger, or if you had a surplus earlier, but the surplus now is reducing. You may still be in a surplus, but the surplus is reducing. In both these cases, you will be said to be in a expansionary policy. If the deficit is reducing, or the surplus, budget surplus, that is revenues minus expenses, is increasing, then we will say that we are in a contractionary fiscal policy. That means the government is spending less and earning more. Taxes are higher, but the government is not spending as much. Again, why will it do it? To affect aggregate demand. To increase aggregate demand, we've studied policy should be expansionary. To decrease aggregate demand, policy should be contractionary. And we also studied some problems that even an expansionary policy may not increase demand, or a contractionary policy may not reduce demand as much. That is the issues we studied with fiscal policy. So economists often use a measure called structural budget deficit, or cyclically adjusted budget deficit, to gauge the fiscal policy. This is the deficit that would occur based on current policies if the economy were at full employment. So the problem is that the deficit and surplus may increase or decrease not because of any discretionary policy. The deficit may increase or decrease just because of the business cycle. So if you're in a bad business cycle, government deficit may increase. If we are in a good business cycle, government deficit may reduce. Taxes may be high. Now, just because deficit is changing also doesn't necessarily mean that the policy is expansionary or contractionary. To say that the government policy is contractionary or expansionary, we often see at a cyclically adjusted deficit. That is, adjusted for the cycle, are we running a higher deficit or are we running a lower deficit? Adjusted for the cycle, if you're running a higher deficit, that means the policy is expansionary. Adjusted for the cycle, if you are running a lower deficit, that means the policy is contractionary. Because some change in deficit and surplus will happen just because of the state of the cycle that we are in, or because of the current business cycle in good time or bad time. So guys, generally speaking, if both fiscal policy is also expansionary and monetary policy is also expansionary, then interest rates will usually be lower and both private and public sector will expand. So government is also spending, interest rates are also low. If both are contractionary, again the other way around. If fiscal policy is also contractionary and monetary policy is also contractionary, that means aggregate demand will go down. Government is also not spending, interest rates are also high. If fiscal policy is contractionary and monetary policy is expansive, in this case, if both are contractionary, this is what we just discussed. If both are contractionary, in this case, GDP would be lower, interest rates would be higher due to the tight monetary, both private and public sector would contract. If fiscal policy is expansionary and monetary policy is contractionary, that means government is spending. Government will spend normally through government enterprises and through government programs. So aggregate demand will be higher due to fiscal policy, while interest rates will be higher due to monetary policy. So in general, to answer these questions, you can say that monetary policy will have a higher impact on short-term interest rates. Or you can say that monetary policy will have more impact in general on interest rates. So if government is expanding but interest rates are high, so then private sector will be most hit, because interest rates will be high and government is also borrowing more. So government sector will expand, or government spending as a proportion of GDP will expand, and private investment as a percentage of the GDP will come down in the case of expansionary fiscal and contractionary monetary policy. In the case of contractionary fiscal and expansionary monetary policy, again government is spending less and interest rates are low. So private investment will take care of the demand. That means most of the demand is being met by the private sector. Interest rates are also low. So private sector will expand because of the lower interest rates and meet the demand that is not being served by the government spending, or have a bigger share in the economy. So remember, monetary policy impacts interest rates. If interest rates are low, private sector will expand. If interest rates are high, private sector will contract. Government spending will have a direct impact on government share of the GDP. High government spending means higher government share in the GDP. Low government spending means lower government share in the GDP. You can just remember this table also says the exact same thing that we have discussed. Monetary policy will have an impact on interest rates. Fiscal policy will have an impact on the total output. Generally speaking, if fiscal policy is tight, output may be lower, but it will be inconclusive. Because if monetary policy is expansive, then maybe private investment makes up for the tight government policy. If fiscal policy, however, is easy, then generally we've seen that output will be higher or GDP growth will be higher. You can just take a second and revise this table. So that was about the review on monetary and fiscal policy. Not very testable, but even if questions come, should be easy to attempt, but good to know, because you read this in your papers all the time. This is what governments do all the time, and decisions what governments take. Fiscal policy decisions are taken by politicians. Monetary policy decisions are taken by the central bankers. You read about them all the time in the newspapers and in your financial journals. So you should, good to know what their objectives are and what is generally the thinking behind any of the decisions that these people are taking. Okay, thank you. Fiscal policy